Hi everyone, we're doing a quick audio test. If you can hear me, please type yes in the chat. We'll begin shortly.
Jen, are we good? Good afternoon, everyone. Welcome to our bankruptcy discussion today. My name is Lena Combs. I'm a partner at Withum, and I'd like to welcome you all to our discussion. Our purpose today is to provide guidance about some general bankruptcy matters. Our topics for the day include an overview of bankruptcy, the bankruptcy process, Chapter 7 versus Chapter 11, some unique variations, non-bankruptcy options, creditor issues, and finally some income tax considerations. At any time during the webinar, please enter any questions you might have in the chat box. We can get to those as they come in or at the end, whatever time permits. I'd like to introduce today our panelists, Ken DeGraw, who's also a partner at Withum, and Darren Mills from Widerman Malek. With that being said, we'll get started. So Darren, just as a brief overview, can you give us, since bankruptcy is a legal process, can you give us sort of a 30,000-foot view of the process?
Sure. So from just from a statutory perspective, you know, the bankruptcy, and for people particularly that practice tax, there's a lot of sort of similarities. It's very rule driven, but the bankruptcy code itself, our U.S. Constitution authorizes Congress to enact rules under the bankruptcy law so that people essentially can get a fresh start. And if you're familiar with the structure of the U.S. Code, you know, it's Title 11 of the U.S. Code. For those of you that do tax, the income tax code is contained within Title 26. And I apologize, Lena, am I supposed to be advancing the slides or? Nope. If you go one more, please. There we go. So bankruptcy itself, most bankruptcy filings are voluntary. I just submitted one last night for a small business debtor. They can, however, be involuntary, and that essentially is where the creditors force the debtor into bankruptcy. When you file the petition, it creates a fictional entity. You create your bankruptcy estate. And so the purpose of that is to draw a line of demarcation between your pre-petition bankruptcy debt and your post-petition bankruptcy debt, because anything post is generally not going to be subject to discharge, but anything pre, unless it's otherwise not dischargeable, could end up being discharged in the bankruptcy process. And so what happens is the estate, pretty much anything that, there's a last sub-bullet point there, points out, any property of the debtor, whether the debtor has a legal or equitable interest in that property, becomes property of the estate. All right, so if you could advance the next slide, please. I think we missed a slide. Go back one, please. There we are. So, oops, back one. Technical difficulties, I guess. So when you file, there's certain parties to the bankruptcy estate, right? There's the debtor themselves, there's a trustee, and depending upon what chapter you file under, will dictate the level of participation by the trustee. The trustee is generally either a practicing attorney or a CPA. And then you have your U.S. Trustee's Office, and as our slide tells us there, they have a supervisory role. And then, of course, you have advisors. You have your financial advisors, your investment advisors, attorneys. So on the financial side would be somebody like my co-presenter today, Ken, helping with from an accounting and that kind of a perspective, restructuring the company. Those can be very important roles in helping the company succeed through bankruptcy. And then, of course, you have your creditors. A lot of what we're initially going to talk about, a lot of these points are going to relate to what I'm going to call a general Chapter 11. So, all these major companies that have been running into bankruptcy recently, just to create a background or, a baseline, I should say, for when we get to what's now called Subchapter 5, which is relatively new. So you can hopefully see the differences between what applies to a Hertz of the world, which is currently in bankruptcy, versus my client that filed last night. Okay. All right, next slide, please. Luckily for attorneys, the bankruptcy rules dictate that if you're filing a business bankruptcy, you must use an attorney. If you're filing a consumer bankruptcy, you don't need to use an attorney. You can do it pro se or on your own. Obviously, it always makes sense to use an attorney, particularly if you're going into Chapter 13, which is much more of a drawn out process than Chapter 7. No matter what chapter you file under, for example, and I'm going to talk about this a little bit more later, but when you have an executory contract, for example, commercial lease, and you go into bankruptcy, you have the ability to either reject that or reaffirm that contract. Reaffirming meaning basically that, hey, I want to keep this contract in place. I want to maintain the same terms. I'm okay with that. And then you just go through the process of reaffirming that. Conversely, if you're not okay with the contract and you want to get out of it, then you can reject the contract. All right.
Great. Thank you. Could you walk us through sort of a typical timeline of the process?
Sure. So the first one, pre-filing planning, generally doesn't happen nearly as much as it probably should, right? Because people, particularly for your medium to smaller size businesses, right? They just don't have the resources necessarily to get people involved. And then, what's my personal experience is the oh crap moment, right? They just hit a point in time where they can't move forward and they need to do something. So not enough time, unfortunately, is given to pre-planning filing because there are certain requirements that are, needed with the bankruptcy petition, particularly for a small business. And oftentimes the clients don't have that data ready, right? And more importantly, from, my perspective or somebody like Ken's perspective, right? If we have up-to-date good data, we can help that client plan for a successful exit from bankruptcy, as opposed to me scrambling, pulling data together that, the old garbage in, garbage out, and then hitting the send button on the petition just to get it in. And then, we're still scrambling because we still have garbage, right? So we still have to get that fixed. Most importantly, one of the most powerful things in the bankruptcy code is once you do file that petition, it triggers what's called the automatic stay. And at that moment in time, any and all creditors must cease collection activities. The only way typically they can continue is with a court order. Ken's actually going to talk about a little later on operating during the Chapter 11 process and things that happen during there. The crux of Chapter 11 is your plan of reorganization, right? And that is basically the roadmap as to where you're getting everybody to agree that this is how I'm going to reorganize my entity. This is how I'm going to keep it going. This is how I'm going to pay my creditors, and things of that nature, right? And then, of course, you have the emergence and you come out and hopefully everything is going as planned. But as we all know, life doesn't happen that way, right? All right. So kind of talked about some of this stuff already. Planning obviously in advance is always the best case, but that, generally most of the time it's just not realistic for a lot of, the clients that between Withum and Widerman we'd be helping. Even Hertz, right? I mean, I'm sure, they just hit a point and they were just like, we got to go into bankruptcy. So, just other things to think about. Accounts receivable being collateralized, that actually raises some issues. Oftentimes people will do some factoring of the receivables prior going into bankruptcy. So whether or not that gives rise to a secured, creditor in that case, the other thing there is, new suppliers could be approached because of more certain financial backing, i.e. you're going to write the purpose. I'm getting a little bit ahead of myself, but, the purpose of going into Chapter 11 is to reorganize your business, right? And come out with that fresh start, a new balance sheet. So that could be, appealing to investors. And I am already getting, I filed something at 8 o'clock last night. I've already gotten multiple messages from people that do debtor in possession financing, looking to lend some money to my client. And then the last thing I'm just going to point out is, losing divisions or operations can be ended, right? Again, bankruptcy can be a major sledgehammer. People often think of it, unfortunately, in a negative connotation, but it can be a very powerful tool to help your company reorganize and survive. And particularly for owner operators, right? That's your livelihood and that's how you're looking to make your living. And, obviously it's very important to have that goal achieved.
Darren, I just throw in, I was actually having this conversation a little earlier this morning with a client who's potentially filing, and they've had the time to plan it. And one of the things they had overlooked was a communication plan. You've got 3 big constituencies from customers and vendors and employees, and filing for bankruptcy can be extremely disruptive. Employees are worried about losing their jobs. Customers are worried about, are you still going to be able to service me? Vendors are worried about not only the money they're owed, but is there a continuing relationship? And how you're going to communicate with those folks in terms of going forward, particularly when we're looking at an 11, which could be an extended process.
Yep.
So having that plan in place goes a long way.
That's a
yeah,
great
and that is an excellent point, and the reason why, ideally having, your attorneys and your, financial advisors, people like Ken, at the table, is important to particularly getting a successful plan of reorganization.
Great. Ken, can you talk to us, give us some insights on Chapter 7?
Sure thing. So, everything pretty much Darren's talked about to this point relates to Chapter 11. And in 11, the goal is to emerge and continue on a successful business. Chapter 7 is the reverse. For whatever reason, the business has failed, and there is no future. At this point, it needs to be liquidated. What happens, the beginning process is exactly the same, where you're going to file a petition with the bankruptcy court. At that point in time, the Office of the United States Trustee, who oversees the bankruptcy process, will appoint a trustee to oversee the liquidation of all of the assets. You're effectively handing them the keys and walking away. That individual's job is to take all of the assets of the debtor, whatever that business entity looks like, and liquidate them. Sometimes there's auctions. Sometimes there are individuals that are very unique and they're able to go directly to market. Their job is liquidate all those assets, and whatever the bucket of cash is that is then derived, The bankruptcy code provides for a series of priorities, and that cash then goes to the various creditors in order of priority, one with one layer of needing to be backfilled before the next gets paid. And sometimes it's a quick process, sometimes it's an extended process. I know we're talking about business, but I'll just throw in individuals also can file for Chapter 11. I'm sorry, Chapter 7.
They can file for Chapter 11.
They
It's
also
rare,
can
but
do
they can.
11. When an individual decides to file for Chapter 7, the rules are a little bit different in that they need to do something called the means test, which was put in place back in 2005 to make sure people who don't have significant income as defined are filing for a Chapter 7 and forces them into a Chapter 13. And then there's a further limitation in terms of the amount of debt that they may have, which, as Darren mentioned, can force them then into a Chapter 11 and exclude them from both a 7 and a 13. Individual debtors also have certain exemptions that they can take advantage of. They're nothing to write home about by any stretch. There's a federal schedule and a state schedule. Generally, the ones that most individuals are concerned about are their home, and different states treat it differently. Darren being in Florida can probably talk to that one. And certainly retirement assets are the other big one that gets excluded in its entirety. And one of the fatal flaws that I see a lot is particularly small business owners will use their retirement assets to sustain a business beyond the point of no return. And the unfortunate part is that they would be able to use those retirement assets to create that fresh start and to move forward with their life and instead they've been pumped into the business and they're gone. So it's an unfortunate set of circumstances.
Great.
Excellent
Thank
point.
you, Ken. Darren, can you expand on Chapter 11 for us and talk about some of the issues to be dealt with there?
Sure. Some of this I've already mentioned, but go through it again. So the idea behind Chapter 11 versus a Chapter 7, which Ken was just talking about, is rehabilitation of the business. I'm not going to say entity because it's possible it's a sole proprietorship, but the business and the maximization of the amount of money that can go to the creditors, right? So back to a Chapter 7. I had a client file a Chapter 7 recently, and just he was walking away. He said, "I'm done." And as Ken pointed out, the trustee takes over, takes control of all the property, and decides what to do with it. In an 11, the most importantly is the owner operator will stay in control. Unless you do something that the trustee's office is not particularly fond of, and they decide to boot you out and put a trustee in control. But you are what's called the debtor in possession, and that's a very important point, right? You're not giving the keys over to the trustee, which is exactly what I say. The same thing Ken does, who you're giving the keys to. But the benefits of Chapter 11, again, as I mentioned earlier, is the ability to, reject commercial leases or contracts, right? So, for example, Ann Taylor and Lane Bryant, right? They went into bankruptcy. They announced they're closing 1,600 stores, right? So that means they're severing all of those contracts, and the bankruptcy code gives them, the hammer to do that. You've got the ability to refinance your debt. Again, there's lots of entities out there that do debtor in possession lending. If you've got significant contingent liabilities, potentially getting those, wiped away. And then something called the 363 sale. And that is the ability to, which a number of the larger companies are doing. They're going to bankruptcy to use bankruptcy to take advantage of Section 363 and sell their assets free and clear of any liens, right? Which is, of course, very appealing to a buyer. All right. Kind of mentioned some of this already, right? But the company continues. Management, continues to operate the entity, referred to again as debtor in possession. During bankruptcy, your pre-bankruptcy unsecured debt doesn't have to be paid. You know, again, the company is going to be under the supervision of the bankruptcy court, right, and the judge. And then I already mentioned that debtor in possession, so I'm not going to talk about that again. And the final point there is, you know, on the downside to this, there are always some negatives, but it is pretty much anything you need to do is going to require court approval, right? Because the courts also got to make sure that what you're doing is not to the detriment of the creditors and what have you. Ken mentioned earlier, Congress enacted the means test because unfortunately people were like running into bankruptcy court left and right to take advantage of what the law allowed then. So the judges do have a duty to be objective, right? They have an ethical duty. They're required to be objective. All right. Go on to the next slide. This point is for what I will call a regular Chapter 11. So the unsecured creditors will form what's called the creditors committee. And as we have in a sub bullet point there, to the extent you qualify, as we'll talk about later, a small business under subchapter 5 of Chapter 11, you do not have a creditors committee. Okay. And again, very important concept. Management continues to run the business as a debtor in possession. Sorry. And from a timing perspective of the Chapter 11, I'm drawing a blank, but I think the fastest so far for a regular Chapter 11 has been like 30 days or something. But that is not the norm. The norm is typically it takes quite a while. And again, for larger Chapter 11s, the Hertz is I'm going to keep using Hertz. I mean, I'm sure you see in the news, right? They've put forth a couple different plans, and what has happened? The creditors have come forward and they've countersued, right? So, that obviously costs money, of course, but also delays the process, right? So again, depending on, particularly if it's very litigious between the creditors and the debtor, then it's going to take more time. And of course, who wins? The attorneys, right? The attorneys win.
Right.
Yeah. I can say that because we're not one of those. Those are your larger law firms getting those fees. But yeah.
And I would add that the creditors committee will also have their own attorney and financial advisor. Those individuals are also paid by the bankruptcy estate, so they're essentially paying for two sets of advisors, plus all the other ancillary professionals that are involved in a case, which is why Chapter 11 becomes so extraordinarily expensive as it stretches out for an extended period of time.
Yeah, for sure. And you probably, was all over the Wall Street Journal, but a former employer of mine, they were running the Lehman Brothers, wind down the bankruptcy estate, and the amount of fees they got was astronomical. I think it was pushing $100 million in fees or something. Anyways, so, and we actually, the other thing, just as a side note, there is something called a Chapter 11 liquidation. Again, it's more often used in the larger company context, but that's also a possibility. So if the business for some reason has no assets, or if the unsecured creditors would get very little, again, I'm going to be talking more in this, and this is more of a regular 11 than a subchapter 5. The creditors are likely to allow more time to develop the plan. Okay. If conversely, there's likelihood the business will continue once the creditor or liquidity problems are worked out, right? The creditors might also be more apt to give the debtor more time to develop, right? Again, because the idea behind Chapter 11 is a reorganization and getting that business to survive so that everybody wins post bankruptcy. The last bullet point too is your creditors are business people, right? So they other than perhaps some of the things that are happening with Hertz, but as an example. But generally, right, the creditors are going to work with the debtor because, you know, they want the company to be successful. They want the company to reorganize. You know, they ultimately want to get paid. They want to maximize the amount of money they get paid, right? So it's generally in their best interest to work with the debtor for a successful plan of reorganization.
Right. Ken, can you kind of talk to us about how businesses operate in Chapter 11?
Sure. So there's a number of things happen once that automatic stays in place, the petition's in. The first thing that's going to happen is something called first day orders, which we don't have to get into the weeds on, but essentially those are the the collateral. Generally, you've got a lender that has a lien on all of the business's assets. It's just a blanket lien. Some of those orders are going to be to give you permission to utilize that collateral, including cash. Other things might be to continue paying payroll taxes, sales taxes, and continuing to operate. As Darren mentioned, you're now considered a debtor in possession. And to that end, one of the things that gets overlooked sometimes is you need to go to the bank and open up new bank accounts that are called debtor in possession accounts. You can't continue to use your existing bank accounts. The creditors, by and large, because a lot of them are maybe owed a significant amount of money, may now want to change their terms because they don't want to be at risk for any further loss of cash. So they may start looking to you for COD terms, or a letter of credit, or some other avenue. We're not talking about preference actions today, but actually I will touch on it a little bit later on, so I'll hit on that. But there's a potential where they could need to pay some money back into the estate, and we'll talk about that. As Darren mentioned, anything that the debtor wants to do, as long as it's within that ordinary course of business, things that have always been done, you can continue to do that without any interference from anyone. Once you want to do something that's outside that, however, you do need to go back to the court. So if you want to take out a loan, you want to sell assets, all that needs to be approved by the court prior to it happening. The other thing that's going to happen is each month, the debtor is going to be required to file a monthly operating report. It's a kind of a typical monthly close that most businesses of size go through: balance sheet, income statement, accounts receivable, accounts payable, tax issues, and that gets filed and is public information on the court's website for everyone to see. That needs to be done every single month, and that'll take some people by surprise. And that first one's always a little more of a stress point than the succeeding ones are, but that's something that needs to get on everybody's radar to be done. I think you can flip the slide. So any debts that were incurred prior to the Chapter 11 filing are kind of frozen in time. They're not going to get paid. They get flipped to an account on your trial balance called liability subject to compromise, and you go forward with a clean slate. And what that essentially does is you're able to collect on your receivables and use that cash, but you don't have any existing debt that needs to be paid. So you've kind of got this little bit of a sweet spot for a period of time where you've actually got some cash flow, which helps you get on your feet and positioned to be able to move forward. As I mentioned, some vendors are going to require you to pay them as you go, but hopefully you can arrange terms with your creditors, particularly your larger ones, to kind of stretch that out a little bit and not have some of those more egregious terms. Darren mentioned that you can put in place some debtor in possession financing that may take out existing lenders or potentially bring in a new lender and give them a super priority. And that will allow you to either reorganize or to fund the cash flow as you go. If there's no money to be paid, as the case winds down, all of the post-petition creditors are protected. However, the pre-petition creditors are not. And if there's not enough money to go around, sometimes we see what's called the Chapter 18, meaning it converts to Chapter 7. So 11 plus 7. Couple things to just kind of keep in the back of your mind is that the plan of reorganization is going to be put together with counsel, with financial advisors. It's in a classic Chapter 11, it's a voluminous document. It's paired with something called a disclosure statement, which is just as voluminous. Lays out what it is that's going to happen, who's going to get paid, and how much. Creditors are then given that opportunity to vote on it. And certain percentages of each class of creditor need to vote in favor. Typically, unsecured creditors, which are the typical trade, at best they can hope for is 10 cents on the dollar if they're lucky. Occasionally, you see a 100% plan. It's rare, but it does happen. Sometimes the payments are out over a period of time, and it's not just done on the date of confirmation. The only thing that needs to be paid on the date the plan is confirmed and goes effective is the professionals need to be paid, and that pre-petition stuff needs to, or I'm sorry, post-petition stuff needs to be taken care of. That settlement can be done in the form of notes. It can be done in the form of a payment plan. And as Darren mentioned, the professionals that are in the case, both the debtors professionals as well as the creditor committee professionals, those fees can be significant. And it's one of the things on Chapter 11 is the time it takes and the fees that get run up. That all needs to get paid, as I mentioned, right out of the gate before everybody else. It just kind of goes back to reinforcing the fact that before you even pull the trigger on a filing, you need to be sitting down with your advisors and talking about how do we get out of this thing? What's our grand plan? And what I try to stress with the companies I'm working with is it's not enough just to have to be able to reorganize your debt and to be able to exit the plan and reorganize. You've got to fix the problems that got you there in the first place. And those problems can be everything from, perhaps it was just the loss of a customer, but it can be a lot more systemic than that. It can be management. It can be staff issues. It can be in industry based where there's, something like real estate that will occasionally have significant downturns. You need to understand what caused the problem to start with. Is it, just the product line has gotten stale and you haven't retooled? You haven't been able to bring new things to market. You need to fix that in the 11 process so that when you come out, you're positioned for success. And it's just so important and gets overlooked in the rush to solve the issue of the moment, which is the pressure from the creditors to not pay attention to your knitting and get it done the right way.
Right. Thank you, Ken. Darren, can you talk to us about some exceptions and variations to what we were just discussing?
Sure. And I just made a note to myself because I think I forgot. Didn't really define what a debtor in possession kind of means. It's somebody that when you're the debtor in possession, not only do you get to continue to run your business and so forth, but one of the really powerful things is you step into the shoes of the trustee. So you have all the rights and powers and duties of the trustee. So I apologize that I don't think I mentioned that already. However, what is, finally took a very long time, but got enacted into law in August of last year with an effective date of this February is subchapter 5 of chapter 11. And, as Ken was, pointing out, and my prior life, working for some very large accounting firms, I was involved in some very large bankruptcies, and I know what the fees are and the cost and what have you. The large companies, they typically have, the deep pockets to be able to afford to hire, multiple law firms, multiple accounting firms, multiple investment bankers. Outside of that realm, your mid-sized to smaller business, they don't have that luxury, right? So Congress finally enacted subchapter 5, and again, it was enacted in August last year. It had an effective date of this February. No correlation to COVID. Of course, if Congress had that kind of, foresight, we wouldn't be sitting where we are today. And so a small business debtor is defined as, under the statute, basically you have 2.8 million or less in debt. The CARES Act increased that to 7.5 million, which broadens the amount of, debtors. I was about to say taxpayers, but I guess that still would be true. The amount of, debtors that would qualify as a small business. It's designed purposely to be a much more streamlined process than your typical Chapter 11. So you have 90 days to formulate the plan. There's no creditors committee, as I mentioned earlier, right? So you don't need the creditors to approve the plan. They can challenge it, of course, but you don't need them to approve it. The judge approves the plan, right? And there is a trustee appointed, but again, it's more of a monitoring role than, versus a Chapter 7 where, they're basically taking the keys and figuring out where the car's going. Go to the next slide, please. The bankruptcy code actually has a provision that will disqualify counsel, if they're actually owed anything. The part of the Small Business Reorganization Act which makes sense, is, for example, a firm like us, Withum and Malek, we may have clients that, find themselves in bankruptcy, and, as long as they don't owe us more than $10,000, we won't have a conflict of interest under the bankruptcy code, and we can proceed. We still may have a conflict of interest under the rules of professional conduct, but that's a different issue. Another major powerful thing is the elimination of what's referred to as the absolute priority rule, or rule, pardon me. So, generally what happens, I'll just do an example. I was doing the tax work for a very large utility company. They were a subsidiary of another very large utility company, and the subsidiary went into bankruptcy, not the parent. And as a result of that plan of reorganization, the creditors became the majority owners of the entity. So for tax purposes, you had a deconsolidation. And so you ended up with a different owner, right? A different majority owner. With a small business reorganization, you don't have that, right? It allows your existing owners to retain their full ownership without having to give new value, okay? If there's a cram down, which, means basically, like, for example, secured creditors aren't going to get, what they're really entitled to, then the plan of reorganization has got to meet a distributable income requirement that basically, they're going to get money over 3 to 5 years. A lot of the requirements that apply to a regular Chapter 11, as far as some of these things are concerned, also apply to a small business reorganization as well. So it's a very welcomed change to the law, and it's certainly, unfortunately, because of what's happening with COVID, is probably something that's going to be utilized by way too many businesses, again, unfortunately, for the wrong reason. But, that, again, very powerful. All right.
Darren,
next slide,
before we
please.
move on to the next section, we do have a question in the chat box, so I'm going to read that. Is something within the ordinary course only if the business regularly does it, or also if it is what any similarly situated business would do from time to time, if and when the situation arises, even if the situation only arises infrequently? For example, consider a business that buys up franchises or hotels when they become available, but that happens only once or twice a year unpredictably.
I'm not sure I follow the question.
So the question is about the ordinary course of business. When you were talking about Chapter 11, and the business can operate as it normally would in the ordinary course of what it normally did. Is there,
right,
if they're doing something that they normally would do, but it is not systematic and, happen all the time, it happens, infrequently, would that be considered in the normal? If I'm understanding the question correctly.
Yeah, no, I don't think there would be any kind of limitation there. Yeah. I mean, again, if you're under the court, you may need court approval for certain things, but yeah, depending what it is.
Right.
I mean, if you're buying and selling large, if you're just gonna make up an example, if you're manufacturing widgets, right? And you start, getting into buying and selling real estate, then, that may not be in the ordinary course of business. So it's really going to depend on what their underlying business is. Yeah.
Right.
Yeah,
And I'm
or if
sure.
you needed to incur debt to do those acquisitions that they're talking about, that would require a court approval.
Great.
Right.
Okay, thank you.
Up next slide. There we go.
This one.
Yes, please. So another, again, unfortunately, what may be happening with way too much frequency because of what's happening out in the world right now, and real estate investors, i.e. the landlords, right, not getting paid. If they're not getting paid, well, they can't service their mortgage, right? So you sort of have this ripple effect. The bankruptcy code, and this is not anything, not like subchapter 5, which is new. This has been around. The bankruptcy code has a provision for what's referred to as a single asset real estate. That can be a misnomer, right? It's not necessarily one piece of property, and I'll give you a cite to a case which many people probably know, the home builder. But definitionally, I'm not going to read it. The first bullet point there is actually out of the statute, and that's how the bankruptcy code defines a single asset real estate, right? But to the second bullet point is what I was just mentioning, right? So again, single can be a misnomer, a little bit misleading, right? So it can apply to a debtor with multiple properties, okay? Where those properties are like linked together in some fashion via common plan or scheme. So this is in New Jersey, out of New Jersey, and the bankruptcy court is a federal court, but it has district courts all over the country. And you can actually have one district court issuing opinion that is contrary to another district court. That happens. But so there's a case out of New Jersey. There's only one district court in New Jersey. In re Cara Homes, and that's 363 BR 399. And if memory serves me, they filed for bankruptcy. The creditor went in, and Cara Homes did not designate themselves as a SAR. The creditor went in and filed a motion to have them classified as a SAR, and the court ruled in favor of the creditors. The importance of that is the creditors typically there are secured, right? So they're trying to protect their rights and their payments, or what they're entitled to, pardon me. Last bullet point, these are some court cases. I didn't put the cites there, but the analysis is, where is that source of income coming from, okay? And so again, this could be where somewhere like Lena or Ken could be helpful in, trying to peel apart the onion, so to speak, and where's that money coming from. But the court has held that a hotel that had a significant amount of income from a restaurant, bar, and a gift shop was not a SAR. And similarly, in another case that is a typo, that should not be Maria, it should be Marina. A marina that had stores, that stores, winterizes boats, and also has gas. They had a significant amount of income relative to, money they get from the boat slips, that the court held that they were also not a SAR, okay? And next page, please. So if the secured creditor, and generally, right, that's going to be, when we're talking about real estate, they're going to be the, potentially the mortgage holder. If the secured creditor's claim is underwater, then, that claim can be bifurcated into two claims, right? So you'd have a secured claim to the extent of the value of the collateral, and then any deficiency results in an unsecured claim. What that does, which the next bullet point puts there, is, and this is assuming you don't fall under subchapter 5, this would permit the debtor, the creditor, would permit the debtor to the creditor, said it again, would permit the creditor to vote twice on the plan, right? So again, 2 bites at the apple versus 1, okay? And the other thing that happens with a SAR versus a regular Chapter 11 is you've got a tighter timeline to get the plan of reorganization done, or the code itself will require you to begin making monthly payments to your secured creditor in accordance with the note. All right. Anything else there? I think it's good. I think that's the last slide on that one, right?
Yes.
Yep.
You want to talk briefly about some non-bankruptcy options that people can consider?
I will, and I'm just going to do literally 30 seconds, I think, on this because interest of time. There's something called the assignment for the benefit of creditors. This is actually a state law process. And, you know, I tell people it's a kind of akin to a Chapter 7, right? A receiver is going, as opposed to a trustee, it's nomenclature. I mean, it's very similar. But again, it's a state law process. The receiver is going to take over the company and basically liquidate the assets in favor of the creditor. What's probably more important is, again, you know, unfortunately, if we're talking about Chapter 11, it's not necessarily the end of the world if the business goes into Chapter 11. It can be a very powerful thing, but you know, before you get to that point, if we're doing proper, this goes back to sort of pre-proper planning, right? One of the first things to certainly try and do is see if you can settle or negotiate with your creditors, right, prior to going into bankruptcy, which a lot of my colleagues who do commercial litigation and things like that, they do that all day long, right? They're trying to negotiate with their creditors so that, you know, our client, if they're the debtor, you know, can get to a point where they can actually make their payments and, you know, move on with their lives.
Great.
Yep.
Thank you. Can you talk to us about creditor issues and what potential filers should be aware of?
Sure. So sometimes, obviously, you're not the person filing for bankruptcy. You're on the receiving end, which is never a positive occurrence. A couple things that a creditor needs to do to be sure their interests are properly protected. In a Chapter 11 context, one of the first things that's going to happen is something called a 341 meeting, which is where you'll be invited to go and listen to what the debtor has to say and ask questions. If you are lucky enough, I'm not sure that's the right word, to be a top 20 creditor, you may be invited to do something called to join the unsecured creditors committee. That because the court doesn't want any number of unsecured creditors showing up at the courthouse on any given day, what they do is they form a committee to represent the interests of the unsecured creditors. So the largest of creditors are given an opportunity to serve. If enough of them are interested in doing it, the committee will be formed, and then they typically will be very active in the bankruptcy. The preference defenses, I mentioned it briefly before, where payments made by the debtor to you within 90 days of filing for bankruptcy have the potential to be clawed back. If you get one of those lovely demand letters after you come down off the ceiling, contact your accountants or your bankruptcy counsel. And there are some defenses that are available in the interest of time, but we can't get into them today. But know that they're out there, and there may be a way to mitigate the damage, if not eliminate it. Critical vendor status is also available to certain vendors. What happens there is that some businesses are served by providers with very unique goods that just can't be resourced somewhere else easily. They are able to get something called critical vendor status. This is part of those first day orders I was talking about. The magic of critical vendor status is that it allows you to get paid on your pre-petition debt where no one else is. So it's a powerful category to find yourself in if you can fit within the constraints. And it's not easy to get, but if you can, that's fantastic. In any case where it's an asset case, and this can be a Chapter 7 or a Chapter 11, the court will send out a notification to you asking you to file a proof of claim. A proof of claim is a relatively simple document, but it's important because you can only imagine the state of the books and records of the debtor entity. It's generally not pretty. They are putting together their petition based on those books and records. And Darren mentioned garbage in, garbage out. It's totally applicable here. You, as the creditor, will have better records and better information in a lot of cases than the debtor does. The proof of claim allows you to identify the amount of money you owed, provide for the relevant amount of support for that claim, which is important, provide that support because these do need to be reconciled. And as well, are you entitled to any particular preference in the bankruptcy action? And the final thing I'll mention, because I'm sure we're starting to run tight on time, is reclamation actions. And that's where you can claim your goods back if delivered within 45 days of the bankruptcy. The reality is they're probably covered by a blanket lien and you're going to be out of luck anyway.
Great, thanks, Ken. Our last topic is some income tax issues. Can you continue and give us sort of a rundown of some of the tax issues that a debtor will confront?
Sure. So we could spend a day on this, so we'll try to condense it to 5 minutes somehow. The first question that inevitably comes up is, can I get my taxes discharged in bankruptcy? And the short answer is no. The longer answer is maybe. If those taxes were are more than 3 years old, so we're talking about stuff that might have been filed in 2015 at this point, maybe 16. They were filed at least 2 years before the bankruptcy petition was filed, and they've been assessed within 240 days of the filing, then maybe. The way you deal with that is your financial advisors are going to get transcripts from the IRS to figure all that out. Now, all of these limitations that I'm talking about in terms of timeframes can be stretched if you've done something along the lines of filing for an offer of compromise. There's a previous bankruptcy, due process hearings. There's lots of stuff that it can extend the statute. So it's very important to make sure you're crossing T's and dotting I's before you file a bankruptcy in hopes of getting rid of tax claims. That all said, I'll tell you that if you do have trust fund taxes, meaning unpaid withholding taxes, those will not be discharged in the bankruptcy, and those also carry personal responsibility. And obviously anything that relates to fraud isn't going to get discharged. So that's kind of the good, the bad, and the ugly. I do know that if you keep your eyes open to my LinkedIn page, I'm working with another gentleman out of Texas who's another financial advisor, and we're going to be doing a couple sessions specifically on bankruptcy tax, if that's of interest to you. You can flip that. So there's a number of other issues that inevitably pop up around a bankruptcy filing. There's a period of time where the debtor typically is having all kinds of issues, and a lot of times what I see is that returns just stop being filed, particularly income tax returns. Those remain the debtor's issue, particularly in a Chapter 11. You're going to need to catch up. So you need to get a plan put together to get that to happen. And they're supposed to be caught up by the time the petition is filed, but I haven't seen the courts be particularly sticky on that issue. In a Chapter 7 where a trustee is being appointed, the Chapter 7 trustee will typically deal with things that happened during their oversight and aren't going to get concerned with stuff that should have been filed prior to their appointment. In a individual 11, separate bankruptcy estates are filed. There's a whole separate set of issues there where there's a separate entity that's created. And for business entities, you continue with your life. Nothing really changes from a tax perspective in terms of your compliance requirements. It all just continues. If you're an LLC and you're elected to be taxed as a partnership, that doesn't change. If you've elected S corporation status, that doesn't change, nor can you change them because those are considered to be property of the estate. In the interest of time, I'll kind of cut it off there, and with Darren kind of pick it up here with COD issues.
Yeah, Darren, when debt's canceled or forgiven, how's that dealt with?
Yeah, and I apologize. I just noticed, I think we have semi-duplicate slides. They're not even completely duplicate, but the content is the same. So just real quick, from gross income under Section 61 of the Internal Revenue Code would tell us that cancellation of indebtedness is gross income for income tax purposes. However, Congress does provide for an exclusion. As you'll see below, exclusion is a misnomer, just like when you have a tax-free reorganization, that is a misnomer as well, because it's tax deferred. But if a taxpayer, whether an individual or entity, is in bankruptcy, there is the potential for that COD to be excluded. However, for particularly with the prevalence of LLCs out there, you may have an LLC that's taxed as a partnership. You may have another LLC that's taxed as an S corp. With the 108 rules work differently for a partnership than it does for an S corp. As you can see, the partnership, that's just an item of gross income that gets allocated to the partners under subchapter K, and then the determination of whether the COD is excludable is actually made at the partner level. So the partner either has to be insolvent or the individual partner themselves in bankruptcy. Of course, it could be an entity partner as well. I said individual, but the partner has to be in bankruptcy. Conversely, if you have an S corp, the exclusion is tested at the entity level. For those of us who have been, my prior life, I did a lot of tax. For those who have been around a while, that was actually a congressional fix to a U.S. Supreme Court case called Gitlitz. Congress didn't like what the Supreme Court, ruled on, so they fixed it. I know there's some practitioners out there that, are potentially advising people that if you have real estate owned in an LLC to potentially consider making an S election. Just be careful if you have basically your liabilities are in excess of your basis, you could have 357C gain. And also LLC operating agreements could give rise to a second class of stock depending upon what's in there. As I said, it's a misnomer 108 as an exclusion because it's effectively a deferral, right? So if there is debt that is excluded under bankruptcy, then you have to reduce your basis. Quick example, we had a client recently that is actually selling their home. They were a developer, not unusual, right? They had to make personal guarantees on things. 2008 hit. They had to go into bankruptcy, both at the entity level and personally. Well, they're now selling their home, and guess what? That's coming back to haunt them because they're actually going to have taxable, not all their gains going to be excluded under Section 121 because they had to make a basis reduction to their home. So again, it is sort of a timing issue. The other thing I'll just mention here real quick, and I fortunately didn't write it down in my notes, so I don't have a cite for you, but there is a tax court case where the tax court has held that if there's foreclosure and you realize CODI from foreclosure, that actually is not fall under Section 61A, Section 61. Oh my God, 61A11, it actually is treated as capital gain for the sale or exchange of an asset. So therefore, it is not subject to, you can't exclude it under 108. So another thing to, unfortunately, in the environment we're dealing in from a tax planning perspective, to keep on your radar screen. Yep. And yeah, I mean, I'm not gonna really mention, other than the last bullet point here, because I apologize, somehow we ended up with duplicate slides. For if you have a grantor trust, right, or a disregarded entity, and it totally makes sense, right? The ability of whether you exclude the CODI is going to be tested at the owner level. Yeah. And I'm talk about the insolvency exclusion real quick. The bankruptcy, first off, this last bullet point there, if you're in Title 11, you don't have to worry about whether or not you're insolvent, right? You could be solvent, still had CODI excluded under 108. If you're not in bankruptcy, and let's say, what you're doing something outside of the bankruptcy court and you result in some debt forgiveness, then you need to look at the insolvency exception, and which would be whether your liabilities are in excess of your fair market value or assets, right? And most importantly, those assets would include, for example, intellectual property, right, which may not be on your books. So you may, even though your balance sheet, your book balance sheet or your personal balance sheet may say you're insolvent, you may in fact not be insolvent. And so, which is good news for people like Ken, because you have to bring them in to figure out what your value is, right? So best practice, if you're looking to exclude some CODI under the insolvency exception, is definitely get a valuation done.
Great.
Yeah.
Thank you, gentlemen. I don't see any more questions in the chat box, and we are out of time. I did just want to thank our participants, our attendees for attending today, and our panelists for disseminating such wonderful information. You will, all of our participants will receive a survey after the event when the webinar closes. If you could please fill that out and give us any potential topics you'd like to hear from a bankruptcy perspective going forward. And our contact information is on the screen here. If there are any questions you have that did not get answered or something you'd like to follow up on, please feel free to email any of us and we'll be sure to get you an answer to the question. Thank you for attending.
Thank you.
Bye-bye.